With that, I'll pass the floor to Bob and Michelle.
Thank you, Michelle, and welcome everybody to our final town hall for 2020. It can't end too soon. I guess looking back at what's happened in the past year, some of our wins, and just one of them would be in the throne speech. Farmers and ranchers across Canada were acknowledged in the role that they play in the fight against climate change, and that's a pretty major admission from the government that we've never heard before. And moving forward, we will continue to engage in this, and our industry has a great story to tell, and we've got the opportunity to tell it. Consumer awareness really came to the forefront during COVID. People, for the wrong reasons, but nevertheless, they became aware their food comes from, and they're asking food. And there again, gives us another opportunity to tell our story on our production practices, and that we do have a safe and reliable food source. Canadian Centre for Food Integrity's most recent survey on public trust showed an impressive 12-point jump in public trust in the Canadian food industry. CCFI identified in their 2020 report that Canadians are confident in and optimistic about the food they eat and those who produce it. This is a very powerful quote and shows that we have an opportunity to further shape public trust in our food system and bridge the gap on the myths concerning the impacts of beef production in the environment. More recently, we've been engaged with the federal government along with our partners in agriculture, trying to move the bar on business risk management programs. In the latest FedProv territory meetings, the federal government has opened the door to some changes in agri-stability, and I'll let Dennis go into the details on this, but this is the first time that any government has really acknowledged that there needed to be some change, let alone actually saying we will do this. We didn't get all we asked for, but the door is not closed. We've been told the talks aren't over, but they have offered a couple of things that are going to help a lot. And I'll let Dennis talk about them in his time. And I guess with that, I'll turn it over to Michelle.
So thank you, Bob. Good evening, every one of you. My name is Michel Daig, Chair of National Cattle Feeder Association, and I am pleased to participate in the town hall tonight. It has been a busy fall and early winter for everyone navigating the political and social landscape that seems to change daily. Since day one of NCFA's primary focus has been to work with the federal and provincial governments on removing the agri-stability cap, as it has not been addressed in over 20 years in pace with inflation and industry changes. While the payout rate and reference margin limit are also issues in the current program, the cap remains the most significant detriment to cattle feeder across Canada, particularly in times like these. We will continue to advocate for this to be removed or significantly increased, particularly with our Prairie Province government, who don't appear to be supportive on these proposed improvements. On July 31, the federal government announced further investments to safeguard the health and safety of Canadian and temporary foreign workers from COVID-19. Since then, NCFA has been providing consultation and input into the requirement, and we are currently working with our members' HR teams to provide written input into the temporary foreign worker housing consultation. This consultation is open to any business owner bringing in foreign workers, and we encourage everyone to complete it. Throughout the summer, we work on issues such as this by hosting a virtual lobby week where we host almost 30 meetings, hosting many MPs on feedlot tours across Canada and appearing before the standing committee on more than one occasion. At this time, before conclusion, permit me one observation. Consumers pays huge money to buy beef this year, more than ever. Grocers, distributors, and processors never make much money than this year. Meanwhile, at the farm door, cattle feeder and cattle producer never lose more money since Mad Cow Daisy. Where is the problem? That's why we will continue to work with government and other Canadian beef organizations on your behalf to find solutions to our problems. Please don't hesitate to ask questions or contact your National Cattle Feeder Association board member if you need some help. Maintenant, on m'a demandé de faire quelques mots en français. Alors, mon nom est Michel Daigle, je suis le président de la NCFA et je suis heureux d'être avec vous ce soir pour le dernier Town Hall. Alors, l'automne et le début de l'hiver ont été très occupés pour tout ce qui concerne la scène politique et sociale qui évolue tous les jours. Alors, depuis le premier jour, notre objectif à la NCFA a été de travailler en étroite collaboration avec les gouvernements tant fédéraux que provinciaux pour apporter des améliorations significatives au programme de gestion des risques. Pendant que la modification du taux de paiement et l'élargissement de la limite des marges de référence sont en voie d'être acquises, le retrait du cap au niveau de la grille stabilité, ou du moins son indexation, sont loin d'être acquises. Et c'est ce qui pénalise le plus actuellement les gestionnaires de packs d'engraissement à travers le Canada. Alors, on va continuer de travailler très fort dans une direction pour trouver des solutions à ces problèmes-là, particulièrement avec nos gouvernements provinciaux des prairies qui ne semblent pas supporter des améliorations qu'on souhaite, faute de budget. Alors, le 31 juillet dernier, le gouvernement fédéral a annoncé un investissement important en santé et sécurité pour les travailleurs canadiens et les travailleurs étrangers. Et la NCFA a travaillé en étroite collaboration au niveau du processus de consultation avec nos membres. Or, tout l'été, on a continué de travailler sur plusieurs dossiers. Alors, ça a d'abord été l'accompagnement de plusieurs députés qui ont visité des packs d'engraissement à travers le Canada. On a tenu cet automne notre semaine de lobbying de façon virtuelle cette fois, où on a eu au moins 30 rencontres, principalement avec des députés élus de tous les partis. Alors, on a comparu plus d'une fois devant le comité permanent de l'agriculture à Ottawa. Et permettez-moi, en terminant, de peut-être apporter une observation personnelle. Alors, les consommateurs n'ont jamais payé leurs produits du bœuf aussi cher que cette année. Et pendant ce temps-là, nos épiceries, nos distributeurs et nos abattoirs n'ont jamais autant fait d'argent. Alors, pendant ce temps-là, nous, à la ferme, aussi bien les éleveurs que les producteurs de bœuf, on n'a jamais perdu autant d'argent depuis la vache folle. Cherchez l'erreur. Il y a certainement, c'est la raison pour laquelle on va continuer de travailler très fort avec les gouvernements et les autres organisations canadiennes de l'industrie du bœuf pour améliorer notre sort, pour trouver des solutions à ces problèmes-là. Alors, en terminant, je vous demanderai si vous avez des questions ou quoi que ce soit, n'hésitez pas à communiquer avec votre directeur de l'Association nationale des engraisseurs de bovins. Merci beaucoup. It's to you, Michelle.
Thanks for those remarks, Bob and Michelle. Tonight, we will receive informative updates from Dennis Lakecraft, Executive Vice President at CCA, Craig Clemmer, Principal Agricultural Economist at Farm Credit Canada, and Brian Perriott, Manager and Senior Analyst at CanFax. Following these updates, we will open the floor up to questions from producers. We will limit the duration of this entire presentation to 1 hour. Please use the Q&A function at the bottom of your screen to submit your question. We ask that you include your name and province with your question. Please be advised that we will not be taking questions from the chat function. I'll now give the floor to Dennis, Craig, and Brian. Thank you.
Thanks, Michelle, and good evening, everyone, and those from BC, good afternoon. It's great to have a chance to update you, and I think one of the encouraging things is in the spring we were doing this every week, and with all of the focus that was put into resilience and business continuity, we're seeing the results of that as we've gone through this second wave of COVID. And I'm not sure anybody in late May would have thought that we would be processing 10,000 head above last year this week. So to our partners in the processing industry across the country, they're doing an amazing job to protect their employees and at the same time be able to process through cattle. And we're methodically working through the numbers that got backed up during that period of time. I'm sure Brian will talk about that in more detail. And also a thank you to our provincial members and to our beef advisor members who are part of a weekly meeting every Monday where the industry, I can assure you, is working as closely together as it ever has to make sure we're continuing to advance issues on behalf of the industry and make sure we're as fully prepared to get through this as much as possible. So far now our processing levels, our steer kill is above a year ago. Our heifer processing is within 5%. It's come at a cost though. Our cow kill is down because plants have been prioritizing getting those fed animals through the system, and that's been really important for all of us. We continue to work and make sure that advice is available as we move through some of these changing protocols that are out there. And one of the more recent things we've done as a group is, we've requested that our frontline food workers also be given priority in the vaccination schedule that's coming up. These are individuals that, like everyone here, that still go to work every day, that are working either in the plants or working in our retail and food service outlets, who don't have the luxury of staying home, but are out there doing this on everybody's behalf right now. I want to talk a little bit about trade and some of the things you will have seen this week. The Canada and UK announced signing of the provisional agreement because of the challenge of getting something negotiated before the Brexit, and the UK EU negotiations are still going on, and quite frankly are still in doubt as to what will happen there. There was a continuity agreement that was reached, and it's certainly not everything we want. What they're trying to do is ensure that we can continue having access to that market using kind of the CETA protocols until we're able to actually sit down and negotiate a full agreement. And that is really our focus. Within the current negotiations, they did improve the tariff rate quota administration, but candidly speaking, the current conditions greatly favor UK exports to Canada more than Canadian exports to the UK. And we do intend to get that resolved before these negotiations are completed. As I mentioned, our processing levels are up. That means in order to keep the product moving in the quantities that we're doing, exports are absolutely essential. We're almost up to last year's value levels. We're closing in on the volume levels. You may recall in the summer we were well behind because of the fact we just simply didn't get as many animals processed. So we are, by the end of the year, I think maybe even going to be ahead of last year in terms of the value of our exports. And that just signals how important those markets are when we're moving through larger numbers of cattle. And in particular, we're seeing the CPTPP countries taking more product as we're moving forward, and exports are up to Europe, but certainly not to the same degree. Imports are up to Canada, which again reflects some of that earlier slowdown in processing that we were dealing with. We've been working close with our US counterparts as we and they are preparing for a new administration. in the United States. It'll certainly be taking a different direction. We are not traveling like we would normally to meet with the US industry, but we have done a number of messages that have been recorded in virtual meetings. So we can begin to prepare and ensure as there is a change down there, we're well prepared, recognizing 75% of our exports continue to go to that market, and virtually all of our live cattle exports, 75% of our beef exports. I want to talk a bit about the federal, provincial, territorial meeting. You will recall all the way back to last summer, there was a huge amount of analysis and work that was put into it, studying the BRM programs. That information was shared very actively at the federal and provincial levels. And last week, there were a number of significant things that were put on the table at the FedProv territorial meetings. And, you know, before I get into the BRM program, certainly labor was recognized as vitally important. That has been an issue for our industry for close to 15 years. And they recognize that we need to continue to have access to both foreign workers and that, you know, try and build the skilled Canadian group that we need access to as well. There was progress made on the animal health files, and we continue to work very actively to ensure there are things like the FMD vaccine bank, recognizing the US at least currently has said we won't have access to that bank in the years ahead here. So we're ensuring we're prepared, but I think the main item obviously was the business risk management programs. And in that, there were, I think, two very significant things that were put on the table. The first is the federal government tabled a number of proposals, but it got narrowed down to two key items. One was the removal of the reference margin limit and an increase in the compensation rate from 70 to 80%. Now, from our analysis, certainly for cow-calf and smaller, you know, the backgrounding and smaller feeding operations, those were very significant changes that would have considerable benefit to our industry. The minister also signaled that she's prepared to consider other program enhancements with her provincial counterparts. And as Michelle mentioned, we're continuing to ensure that this whole issue of the caps that have been in place in place for 15 years continues to be on the table to make sure that, you know, we can have meaningful programs across the country. That was tabled. The provinces went back. They're in a period now as they're analyzing the impact on that. I know Bob will talk about this more later, but we're working very closely with other parts of Canadian agriculture to really emphasize how important those changes are to finally, you know, restore those business risk management programs to meaningful protection for our industry as we move forward. So we've got some great presentations. So I'm going to stop there. We have a number of people on the line who can talk about that. The final thing that I will mention, you know, kind of behind the scenes, it's really remarkable watching our various initiatives, whether it's public and stakeholder engagement, you know, as we continue to see Guardians of the Grasslands win more awards and getting greater recognition in the throne speech. You know, CRSB is continuing to lead the world on the sustainability front. BCRC is continuing to get the work done, and Canada Beef has really transformed their program so that they can, you know, work with exporters around the world and not lose the momentum we've gained. So, you know, it's really a team effort there, and I want to thank all of them. So that, Michelle, I think we're going to go straight to Craig Clymer. We're delighted to have FCC here to give us kind of the macro look as, you know, agriculture across Canada, across the world has been impacted by COVID. So, Craig.
Yeah, thank you very much for having me. And kind of as mentioned, I'm going to talk a little bit about some of the impacts that we've seen of COVID and where, you know, what that has done to the Canadian economy so far, and then try to relate why this matters to your business, and specifically really hammer in on what's going on with interest rates and the Canadian dollar over the next, you know, into 2021. So I'm going to take a second here and share my screen. So hopefully everybody can see my screen all right. So when we're looking at the Canadian economy here, COVID has really caused a lot of challenges. And when we talk about what this looks like, you hear in a whole bunch of different directions of it. You probably heard an L-shaped recovery, a K-shaped economy, and, hoping for a V-shape. And really those are just kind of what does the downward slope look like, and then what does that recovery look like? And when we think about COVID, it's really coming in a lot of challenges in Canada and around the world. So if we look at what's happened, kind of these mixed signals, I guess, when we look at globally, global GDP is expected to decline about 4%. So, it's just kind of highlighted the importance of trade and our trading partners when we talk about beef and exports. But the other part of that story is how healthy is the consumers and their ability to afford the high quality products that we're sending around the world. So if we think about what's going on, annual GDP for 2020 is expected to decline about 5.7% in Canada. The United States, they've opened up their economy and fighting a little bit harder to try and keep that economy opening. And we're looking at their economy contracting 3.5% or so. The European Union, they've had even bigger issues with COVID and shutting down their economies and trying to restart, looking at declines of about 8%. One of the few bright spots, China was very, very aggressive about coronavirus, when things came to light, shutting down those provinces completely, and looking to have some growth now. So originally we would have thought they were declining, 0.5% or so. They have been able to rebuild their economy as export opportunities have increased, looking at some slight growth in 2020. And I guess the good news story is when we think about it, we're looking at the global economy kind of snapping back a little quicker, growth in around that 5% range globally. And part of that we'll have to watch is we could see some more growth opportunities as the vaccines come through 2021. Maybe we see economies opening up a lot more. And then the other big question is going to be, what do we see on stimulus? And I want to talk about stimulus quite a bit. And it was mentioned just a minute ago here that the U.S. elections are we're seeing a different administration moving into the United States. And, I want to build on that a little bit as well, because one of the things that is going to be really important to monitor are these, the Georgia runoff here for the senators. And the reason why this is going to be pretty important to watch and what the impact is because if we do see the Senate going into being controlled by the Democrats, they can basically run through their stimulus programs that they're looking for without a lot of holdup. Conversely, if the Republicans remain to control of the Senate, then there's going to be quite a bit of this, debate and back and forth. And, regardless of what it is, stimulus is going to happen in the United States. Stimulus is going to happen in Canada as we try to rebuild the economies, get people back to work, especially, the portion of the economy that hasn't, whose jobs haven't been as secured. People working retail, lots of questions about what that food industry is going to be looking like, especially at the food service industry, and people getting comfortable coming into large groups again. So, lots of work and going to be happening to try to stimulate that. And how easy is that to pass through in the United States, I think is going to be one of the big impacts. And that's so important when we talk about the value of the Canadian dollar and with the US being so important for exports, as mentioned before, 75% of our beef exports are going to the United States. And it's just so important when we monitor that and see what those opportunities are. When we look at some of the, just kind of the monthly statistics and what we see, pretty evident what happened with COVID and when shutting down the economies, all provinces really were forced to shut down economies in March and April. We saw our largest declines really in quite some time, as a result of those shutdowns, and no big surprise there. And as the summer months came, as levels seemed to be moderating, looked like we were having things under control, we opened up the economy, we opened up some food service opportunities, and Canadians got out spending some of that money. But, it's been quick to taper off. And, obviously right now, Quebec and Ontario and Alberta, BC have all made some major declines in closing down portions of their economies, and that's going to start coming through in these fourth quarter GDP numbers, and we could see this a little bit more pessimistic. The one thing I would say on the GDP side of things, not such a good story for agriculture, is at the food level. But people are buying quite a bit more Christmas gifts, and we're seeing that instead of spending money on those trips and that, we're spending more money on Canadian products, and there might be some opportunities. We might see some increased demand at food, but because people are gathering in smaller groups, I'm not sure that it's going to translate in terms of major opportunities for the food sector and food products here. The one thing that I think that we can't overstate and we need to really monitor is what's happening on the deficit, because the one thing that's helped push the Canadian economy staying as healthy as it is has been deficit spending and the stimulus programs that the federal government has put in. And we can look at CERB, we look at rent relief programs, just to name a few. Those have been very expensive programs, and as a result, we're seeing the largest deficit on record. So when we talk about interest rates and the importance of interest rates, it can't be overstated right now for Canada and so many other countries around the world. So if we look at where we are, running, these record deficits here, and the impact to debt to GDP, which is turning to be the most common ratio that we're looking at, we've gone from about a 30% debt to GDP ratio at the end of 2019, looking at that really sharp jump into around that 46% range, could go into 50% range. And that doesn't even include what that stimulus package looks like. So, this number here is going to fluctuate a little bit, but, if we spend another $100 billion, I guess, on stimulus to get the economy going out afterwards, and we don't see that recovery in GDP, we could continue to see these rising up numbers in terms of that overall position, that debt to GDP position of the Canadian economy. So, this is something that's going to be really impactful as Canadians, as consumers, as taxpayers. This is something that we need to really monitor. So if we think about interest rate environment where we are right now, and we got these really low interest rates, 5-year fixed mortgages for housing getting below 1% for the first time in forever. It is really important, not just for households, but also for government to finance the debt levels that we're having and to maintain, the spending that has been going on. And I think that's something that's been, that we need to continue to monitor, and we do have to pay this back at some point. So something that is important to see. I guess the one thing I would want to put in those contexts of where we look like from our deficit position. So yes, we do see Canadians' debt to GDP increasing significantly and going up to near 50%. But if we look at some of our other major economies and counterparts that we benchmark ourselves against, we're not in that bad of a position. Japan's at 177% debt to GDP, United States at over 100% debt to GDP now. And all those, these countries have higher debt levels than where we are. So from that perspective of debt and GDP, we're not too bad. Still higher than places like Australia and a lot of the Nordic countries. But I think when we put it into context, it's important to see where we are. That being said, we don't want to keep running up these deficits. As I mentioned, we do have to pay these back, and it's important to consider that. Those impacts in terms of future spending, future social programs, just was mentioned, BRM programs. These things are all coming out of the government coffers and how rich they're feeling and ability to finance these programs. So I think it's important to consider that. And I'm really just looking at federal debt here. So on top of these debt levels, we do have to consider provincial debt levels for the taxpayers in each one of those provinces, and even at the municipal level in many areas. So, this is a portion of the picture, but when we think about the debt and the potential burden on taxpayers, we can see that it's increasing, and COVID is really the reason for it and causing a lot of challenges for the Canadian economy moving currently and moving forward. So this is all really important, but it's also, it's just kind of one of those pieces that we start looking at when we start talking about the interest rates and the Canadian dollar. What's equally important is really looking at what's happening on the balance sheets of the Bank of Canada and the US Federal Reserve. And so to help stimulate the economy, not only has the federal government come into the market with all these programs to help boost household spending and continue to create that health of the households, we have seen the Bank of Canada also coming in a major way. And what I'm showing here on the left-hand side on the graph here is looking at the asset values, or the assets as a percent of current GDP for the Bank of Canada, and then to benchmark it where we are relative to the Federal Reserve. So the Bank of Canada has implemented a very aggressive asset buying program. Quantitative easing would be something that you heard during the financial crisis, and it's the same program that we see in Canada here right now. So the Bank of Canada has been buying debt from the federal government. So as we keep buying, running up these deficits, we do see the Bank of Canada financing a lot of that debt. And if we see where we are from the debt to GDP, we've added about 180 billion this year. We're buying. The Bank of Canada is buying assets at the rate of 4 billion a week right now, down a little bit from the 5 billion where we were not that long ago. But when we look at where that money's coming from and how are we locking in some of these lower, longer interest rates, it's the Bank of Canada looking at financing a large portion of it, buying about half of that debt levels that we've seen so far. And so that's really important to monitor. And why this is so important is when we think about rising interest rates, and we see the commitment that the Bank of Canada came out with again today is to keep rates low through to 2023. It's really a combination of where are interest rates, how is the Canadian economy doing, what does inflation look like, and the ability to unwind these things. Because as the Bank of Canada unwinds this quantitative easing program, these assets, they're selling this back into the market. And that means other institutions, whether it's pension funds, whether it's companies, they need to digest this debt back into the market. So it's kind of adding this liquidity that you would talk about. So when we think about interest rates rising and what that's going to look like, part of the story is the Bank of Canada is going to want to ease the amount of assets that they're purchasing from 4 billion a week down to what they would do in a longer term normal average, as well as start increasing rates. And it's really quite a delicate balance. And what you can see is what happened in the US. So they had a very, very aggressive asset buying program before the financial crisis. And you look at where they were, they had 20% of their debt to GDP, or the assets to GDP going into this crisis. And they've purchased quite a few to help support the US economy. But it took so long to even start seeing some movements in terms of selling off some of those assets the first time around. So what does this all mean? These nice charts, Craig, what does this really mean for me and my business? When it comes to the overnight bank rate, the Bank of Canada has committed to keep rates low at this 0.25% through to 2023. I don't think there's any reason to question why that won't occur, especially when they're making that firm commitment. When it comes to lending opportunities and rates that you will be paying, right now the markets are extremely low because bond prices are very low, as well as these overnight rates are very low. As we start moving into 2021, as the Canadian economy starts increasing, as the US economy starts increasing, and maybe there's some opportunities for the Bank of Canada and the Federal Reserve to deleverage where they are, we could start seeing rates increase, just that demand for bonds increasing a little bit, and we'd get off these record lows that we are right now without the Bank of Canada or the Federal Reserve adjusting their rates. But if we do see any of that movement, it's going to be very, very slight movements in 2021. And I wouldn't see it as a big risk in terms of making future lending or future investment opportunities for your operation. We could see them bounce off these record lows that we are right now, but still remain very, very favorable for making future investments. I also wanted to talk a little bit about the dollar and what we see here. I'm showing the Canadian dollar, the US Canada dollar, as well as the euro to Canadian dollar ratio, because I think we need to look at those stories. Part of the reason that we see some strength, there's such strong strength in the Canadian dollar and obviously negatively impacting our exports to the US in terms of the return that we're getting for our product. Isn't so much that the Canadian dollar is super strong, it's actually more the weakness of the US dollar. And I think that's part of the thing that we need to look at. The US economy continues to be sputtering. There continues to be some challenges there. And as a result, we're seeing some weaker, just demand for US dollars in the global economy. And as a result, we do see the Canadian dollar benefiting relative to the US dollar. If you kind of look at where we are versus the euro, moving mostly sideways and kind of speaking to that more neutral stance on the Canadian dollar, but more of that more bearish view of the US dollar. That being said, as we move forward and what we would expect, as depending on what the stimulus package looks like out of the United States and what we do see there, is that going to increase demand for oil? Is it going to increase demand for Canada's energy products into the US, and that's going to increase demand for the dollar? That could play into a strengthening of the dollar in the latter half of 2021. So we could see that, our expectation is that we see the Canadian dollar moving mostly flat sideways as we continue to figure out what's happening in the COVID situation, as we continue to get vaccines in both the Canadian and US economy and start these economies to start moving forward and building. As we see some strengthening of the US economy, we could see the Canadian dollar decline slightly. But as that stimulus starts coming in, as we start seeing demand for energy products potentially, we could see the dollar start bumping up slightly in the latter half of 2021. So, that being said, probably see quite a bit of volatility on it as we see announcements and reopenings of economies there. But, that being said, trading mostly sideways where we are for the first half of 2021. At the end of the day. It was mentioned, kind of looking at the resiliency of the agriculture industry and where we are. And, I just thought I'd take a stab at, bringing it from this the GDP level into where we're seeing at the ground level, and what does this picture look like? So at the GDP level, this is what we see through the first 3 quarters. If we look at animal production, overall, they're saying it grew 0.6% through the first 3 quarters of 2020 as compared to 2019. If we look at meat products, the impact of the plant closures, cutting back of production and supply managed sectors, we actually looked at GDP in these sectors declining about 2%. That being said, when we talk about Canadian agriculture, when we talk about the meat industry, and we talk about beef as being a catalyst for growth, I think it really talks about that. If we look at how the Canadian economy handled everything, and we look at where manufacturing is versus food manufacturing, Canada's economy has declined 5.7% so far as compared to last year. If we look at manufacturing, it's down about 12% as compared to last year. That being said, food manufacturing overall is about 2% lower. So, there's a reason why Quebec is investing in Canadian agriculture and food manufacturing as a catalyst for growth. I think, all the things that were said about the beef industry and climate and all the good work that's being done so far really speaks to why agriculture is going to be one of those fundamental stones as we build the Canadian economy and those opportunities and food manufacturing and adding value to our products and exports, very much part of that story. And you look at how we're doing in this industry relative to manufacturing, it really speaks why there's some attractiveness in investing in our sector some more. That being said, I think that we need to look at cash receipts. When we look at what the picture is, it's a bit of a mixed story. And I think it's important to digest and understand what's really going on. So we just got the new farm cash receipts numbers. So I'm highlighting that in red here. And we can see that overall, Canadian farm cash receipts increased 8.4%. And that looks really good, but I think we need to really take some time to understand what that picture is, because there's a few things that are really important to note. The big one, first and foremost, if we look at total cannabis sales right now, they're approaching $4 billion for 2020. And it's really masking some of those things that we see in traditional agriculture. So if you just remove cannabis from those overall numbers, farm cash receipts are only up 5.2%. Still relatively strong numbers. And we think about these record movements of grains and oilseeds in Canada. But we start understanding that a large portion of this growth has actually been to the cannabis industry. And when we think about traditional agriculture, the people that that are on the call here, the storyline isn't near as rosy, and we're feeling some financial impacts, and we can't hide that. If we look at livestock specifically, pulling out the story a little bit more, if we look at livestock receipts overall, down 2.2% in Canada. If we look at by province, we can see receipts down 8.6% in Manitoba, 7.7% in Saskatchewan. So we've seen some fairly large declines in that revenue piece, and that's you in the room here, or you on the call here, that are feeling those challenges and having to deal with these impacts on your operation. And that's very much what I hear is talking about with the BRM programs and needing some opportunities there and some, you know, some potential excitement that could see happening there. If we pull this down the one more level deeper, and you know, before we tee it up here for Brian to share what's happening and driving into the numbers, I just wanted to look at the cattle receipts overall and where we're seeing, and really, you know, a fairly tough picture so far through the first 3 quarters. Obviously, a little bit more optimism here in the 4th quarter as we get more current and on the cattle, and we're processing some rather large numbers, and that's really exciting. But so for the first 3 quarters. And we've seen this in our financials in terms of our books and working and talking with customers. You know, it's been a challenging year so far. You know, we started off with optimism and thinking that we could see some strong export numbers, and COVID really restricted that. And we look at cattle and calf receipts so far, down 15% in Manitoba, down 10% in Saskatchewan, some big impacts, and, you know, really at least down, you know, close to 5% across the board, and seeing those challenges that this sector has been facing. So, you know, I think it's important that you're telling your story, sharing those challenges. It hasn't been an easy year. The food service industry struggled significantly. As the economy starts opening up, obviously there's going to be some more opportunities as people start gathering more, and that's something to be excited about. But you know, 2020 is turning out to be quite a roller coaster ride and some challenges so far. I know I don't have a ton of time, so thank you very much, and I really appreciate having the opportunity to speak with you guys today. And I'll be turning it over to Brian to talk about specifics of the cattle industry. So thank you so much for your time.
All right, good evening, everyone. Thanks, Craig. Appreciate that overview and insights into some of the general economic drivers here, and touching on the Canadian dollar, which has certainly been on the move as of late. I can just jump right into it. You know, everybody's talked about, or Dennis and Craig mentioned about the processing capacity or processing rates we've gone, and it's been, you know, a pretty good news story from June on. And it just keeps clicking along here. You know, since the middle of June, we've processed about 77,000 more fed cattle in Western Canada. At one point, we were probably in the hole about 125,000 head. But again, packing plants really focusing on the fed kill. You know, cow slaughters it has suffered somewhat here. Cow prices definitely have taken a bit of a hit due to the limited shackle space and moving from a premium to a discount to the U.S. market for the cow side of things. But obviously the packers are working through these numbers in a good clip. And if you actually take some of the backlog we had earlier in the year, and, you know, between the 77,000 head and we've probably got, there's over 60,000 head on a set aside, you know, that's what's driving our current, you know, us getting current right now is these capacity, the set aside program. And we're seeing our markets, you know, at least stabilize or maybe slightly upticking. For the next, you know, one of the things, it was interesting as we went through the year looking at the backlogs. You know, at first we were talking 120,000 plus cattle backlog, and lots of questions where they were, but obviously the beef sector is pretty resilient in shifting cattle around and you know, we did push some of those cattle back obviously well into, you know, we're still dealing with them a little bit. You know, that drove our carcass weights. You can see in Western Canada, record large. You know, average steer carcass weights a few weeks ago hit up to 970 pounds and have come off and starting to get a little more current. And you also got to keep in mind on the carcass weight side, animal performance has been excellent. You know, we're 30 pounds above a year ago, 20 pounds again above 2 years ago. But a lot of that is just the weather and the performance of the cattle versus so much being a backlog. And that's Western Canada on the right. You've got Ontario. You know, they've been able to maintain, you know, their currentness through all of this. Their packing plants this spring, you know, really didn't step back at all. You know, their carcass weights are actually below a year ago for several weeks. There are a few hiccups right now in Guelph at Cargill, but you know, sounds like they're being, you know, extremely cautious and proactive on managing. There's a few COVID cases there, and making sure they've got the people isolating as they need to be, and slow down production a little bit, but hopefully in the longer run here, it'll be more of a shorter term hiccup than a major issue, but something worth monitoring out there. Next slide. You know, so through this, prices, again, on the left, fed cattle prices, you know, they've taken the biggest hit, obviously, as I mentioned. You know, just it's a shackle space kind of capacity issue there, whether it's fed cattle, whether it's cows, not having, you know, cattle are backed up, where we've got more sellers than we've got buyers in terms of just volumes. Fed cattle price has been very stable for last 20, 25 weeks, sitting around mid 130s, which overall is pretty disappointing market, no doubt, compared to coming into the year fairly optimistic. You can see, you know, seasonally, December is usually a pretty strong fed market. This week we are maybe just ticking out of that range. We've been basically 132 to 138 for all summer and fall, and we are seeing fed cattle hitting about 140 this week. So some of the strongest prices we've seen in quite a while, but overall a little bit disappointing. But at least we're moving in the right direction, as I mentioned, as we start to get a little bit more current. You know, the surprising part of all this somewhat has been the calf and feeder market. Through, you know, despite these, you know, feedlots have been losing extremely, you know, $250 a head easily on a lot of these cattle. You know, feed costs have risen, the Canadian dollar has risen, but yet calf prices pretty resilient in terms of being close to a year ago. Feeders have come off, like 850-pound steers have dropped a fair bit, but you know, the higher feed costs catching up to them. And we've got bigger cattle numbers, still a lot of cattle on feed coming forward into the first quarter and the first half, but barring any sort of production issues, certainly there's going to be there's less cattle around in North America, smaller calf crops the last 2 years. You know, if we don't have any production issues, demand has been quite good for beef, both on domestically, North America wise, and internationally. So hopefully some of these calves, you know, they're still paying up to $215, $220. You get lighter calves that are going to go to grass. We're still seeing extremely high prices over $250, $260 on light 4-weight type calves, which, you know, continues. There's still optimism pricing into these cattle as these feedlots and cattle buyers continue to pay up on calves. You know, touching on cattle on feed, U.S. cattle on feed's near record large, but again, a lot of these cattle are front end loaded. The last couple months, placements have been significantly lower than a year ago, again, which is going to drive to some tighter numbers further out into 2021. Canadian cattle on feed, or Western Canadian cattle on feed, we've been well above a year ago, but again, close to a year ago, probably December 1st. Again, placements a little bit later in November. Very strong marketings. Our cattle on feed numbers are going to be dropping a little bit below a year ago as well. You know, we're not importing quite as many feeders. You know, anecdotally, we're hearing this fall that the data is a bit delayed, but those imports have slowed down. Smaller calf crop, and some guys, feed situations are better. Calves have been a little slower to come to town. So again, cattle on feed lower, still helps us gain. Basically, we'll talk a little bit about leverage for the cattle industry going forward, and you know, we need you know, either need more shackle space or less cattle on feed hitting the market all at once, and that's where we're pointing to, and gives us a little bit of optimism going forward. That said, it's still going to be tough slugging over the next probably 3-4 months, as you know, we work through these bigger cattle numbers, high feed costs and such, holding us back a little bit. You know, we talked about backlog numbers. The other way we're looking at it, if we look at cattle on feed 120 days or longer, you know, it got very extreme this summer, and this is compared to a year ago. You know, obviously when we weren't slaughtering cattle in April and May, that backed up cattle. But as you can see, we've brought that number down, 50,000 heads. Some of these are long fed calves. Some of these are still, you know, we could call backlogged a little bit. But again, if you take the set aside cattle out of there, as I said, we should be pretty much fairly current heading into the new year. You know, touched on feedlot profitability. It's been, you know, a struggle for a couple of years. And again, the profitability, you know, when we're talking cattle around 140, a lot of cattle heading into 2021 are going to need, you know, 150s, you know, mid to 150s. So we're going to need quite a price bounce into the spring market to start seeing some profits and into the summer. Not to say it's not possible, but you know, we're going to need a good market bounce just to return to a break even, which again, heading into the first quarter on the feeder market, we keep saying, you know, feedlot losses, the markets aren't pricing in a lot of optimism. Be cautious on the feeder market. Nonetheless, it's been very resilient moving forward. The calf and, as I said, calf and feeder market's been holding together well. Next slide. Craig talked about the Canadian dollar's been a big one. It's been on quite the rally since basically falling off under 70 cents in the midst of the crisis. Some of our competitors too, whether it's the Australian, New Zealand dollar, they're all strengthening relative to the US. It's much a US dollar story, and we've been balancing with them. At this kind of level, 77, or we're at 78, 70 or 80 highs today. There's not a lot of resilience up to 80 cents, or a lot of resistance between here and 80 cents. But hopefully we are going to see some stability or cap out on this market. But technically, I think from some of these charts that, there could be a little bit more to the upside till we hit the next level of resistance. But again, going to depend on some of that US politics as well as it sorts itself out. And the other big one in all of this is grain prices. And this is where, calf prices aren't great. We all want more for our calves, but despite, the dollar's doing what it's doing, feed costs, into Lethbridge barley around $6 a bushel. Looking at the corn rally in the United States, China's buying up feed grains like crazy, and that's putting a lot of pressure on our feed costs in Canada and in the United States. So again, as we said, this is something that we've got to watch on the calf and feeder market. Hopefully it seems to be topping out here, or it's kind of flattened out. Certainly pricing in some tighter stocks to use ratio, but we're going to see more barley already, good contracts for the fall, hopefully more barley acres, and get our corn production up in the United States as well. But key factors that are kind of working against the calf market, but maybe not being fully priced into the calf market at this time, in my opinion. And, we talk a lot about the price cattle, and unfortunately, beef demand through all of this has been very strong. We've seen, as Dennis mentioned, exports have picked up. Obviously, imports are up this year. We had extremely high prices this in the second quarter, and that's going to attract imports of beef. But again, we're starting to see that level out with changes in these currencies. The US weaker dollar has been a bit of a boost. It's certainly been a boost on the grain markets. We haven't really felt it on the livestock markets, but it could be a factor moving into 2021 as well. If that can sort of slow down. Australian beef imports have dropped significantly. New Zealand, those imports slow down, and beef exports could be picking up, which would give us some leverage. Now, this is just simply an index. Obviously beef demand has been very strong relative to cattle prices. And we're at sort of a historical, or not historical, but a relatively low level in terms of what our cattle prices are relative to the wholesale beef prices. Meaning, there's two ways to look at it. It is frustrating for producers at times. It's that shackle space, the pack. We just don't have enough capacity to process all the cattle. But again, as we head into tighter cattle numbers, there's plenty of dollars in the system to be passed back to cow-calf feedlots and cow-calf producers. And we're turning from a cycle analysis. The U.S. herd's been on a 2 years of a retraction, a declining herd. We're going to start seeing the impacts of that, especially or hopefully into 2021. That'll give us some leverage. So with the strong demand and that leverage increase, if we're getting 5 or 10% more of that wholesale beef price, that's definitely a supportive factor going forward. Again, this is assuming beef demand stays strong, but for the most part, through these times, we've tested beef demand, and time again, realistically, beef demand has remained strong. So we look for that to be an opportunity again heading into 2021 for some stronger prices. But again, that may be a little bit later in the year rather than currently. Next slide, just some of the key factors. Obviously, the supply chain issues, as we talk, cattle market is sluggish relative to beef. The demand has been good. It's just getting these cattle numbers more current. Delayed feeder, we're going to have a few more cattle heading into 2021 in North America. But again, those numbers look to be a little bit more manageable, and will start to tighten further as we head further into the year. shrinking herd, mentioned that. Weather challenges, some dryness definitely in the US. That's maybe further escalated some of the cow culling in the United States. So we're going to be looking at another smaller calf crop in 2021 as well. Obviously, the futures have been struggling. There's been some concerns of COVID, second wave impacting plants. So maybe the futures, unlike the grain markets that have seen, a lot of commercial money come into the futures, they haven't come into the meat markets yet. But that's an opportunity, I think, as well. Canadian dollar is a question mark as it's strong. A couple of things, the feed, the cow-calf sector is in better shape. We've seen a lot lower culling rate this year, less cow slaughter. Partly there's maybe a few more kicking around to come to the market later this year or early next year. But I think there are going to be people with better feed and grass situations that are going to keep those cows another year. So hopefully see some herd stability. And you can kind of see in the bread sales this fall. Bread sales are quite a bit higher than last year. Lots of decent cows, $2,000, $2,500, and top end hitting up the high twos, even heifers touching 3,000, and very more higher end cattle or spots. But definitely seeing interest in the bread market, which is showing a little bit of resilience on the cow calf side despite the challenges this year. Maybe some investment back into breeding stock, which is promising. Just quick, for anybody looking for more market information, obviously FCC helped sponsor, Nag Expert sponsored our mobile site. You can go through our website to get on to see more Canadian market information. Free to use to look at Canadian prices and price insurance and futures and such. And next is just, looking for more information. Any cattle producers can become a member of CanFax and can certainly contact me looking for more details, or the analysts in the office. And I think I've got my contact info here, but that's just a quick overview of the key factors we're watching right now.
Thank you for your updates, Dennis, Craig, and Brian. Before opening the floor to questions, the following industry representatives are also available to take any questions. Fawn Jackson, CCA's Director of Government and International Relations, Janice Tranberg, President and CEO of NCFA, Michael Young, President of Canada Beef, Michael Latimer, Executive Director of the Canadian Beef Breeds Council, and Rick Wright, Executive Administrator at the Livestock Markets Association of Canada. We also have CCA staff helping respond to questions by text. We will now be taking questions. Please type your question using the Q&A function at the bottom of your screen, and please include your name and province with your question. Our first question is from Ashley, and she asked, will primary producers be considered a priority for the distribution of the vaccine? Dennis, I believe that that question would be for you.
Yeah, I think clearly we're seeing some increase in rural numbers that are occurring, and we're trying to ensure recognition of the essential worker status that we have, that as it becomes more available. Clearly the frontline healthcare workers are top priority across the country and the most vulnerable, but we do believe recognizing the importance of the food industry will continue to seek access on a priority basis if we can.
Thanks, Dennis. Our next question is for Craig. And the question is, why is Manitoba down in cattle cash receipts so much more than the other provinces?
Yeah, so I mean, when we look at these would be both volume of animals as well as the the returns that they're getting. So I haven't looked at the numbers, and Brian probably has a bit more. I would suspect it's because there's a smaller herd in Manitoba as compared to some of the other provinces. So they've seen some more declines year over year as compared to what we see in other parts of the province, or other provinces, sorry.
Thanks, Craig. We have another question here. What is the biggest opportunity to increase export value to Canada's beef industry? And I think that could go to either Fawn or Dennis.
We do have Michael Young on as well, who they are pursuing some pretty active work, and particularly in some of our CPTPP countries. I will say one thing that has just sort of started to develop is we're starting finally to get some breakthroughs of a significant way, and the latest in Europe, in Spain, where we're actually getting Canadian beef into the Costco there, and when you actually take the values back, they're extraordinary values that they're prepared to pay for the product. And I've just got to pull up whether it's around $77, I believe, a kilo that that the product is commanding for our tenderloins over there. So that's kind of a recent development. Ironically, the own supply of those animals is also limiting access there, but fun. And certainly, Michael, I think the work you're doing with the Center of Excellence, you made some comments on what you see as the big opportunities.
Sorry, Dennis, you kind of blotted out there, but I would agree that we're definitely seeing a shift in the product assortment and the values that some of the EU countries are. It's not just Spain. We're seeing some really nice value products moving into the UK as well. So clearly they're middle meat items, and clearly they're going into the food service and some of the high-end retail markets, which are the most preferable market channels that we look for in every export market. Further processing in that is more of a commodity-based market where you're constantly fighting with lower cost supply partners. Once you get into that higher end stuff and these consumers develop a flavor for what we're offering, it really does provide a good platform for building on. And we see the opportunity growing, and we hope that it's going to send the economic signals back to Canada, back to Canadian processors, so that they can take a better look, a different look at whether they want to prepare for future opportunities in the EU. So.
And I would just add that you certainly have to look at Asia and the growth opportunity there, and the opportunity that came with CPTPP, and looking at Japan last year and our beef exports increasing in value by about 17%. It was pretty exciting. And I think certainly as we look forward, looking at how can we remove some of those further technical barriers that still remain in a number of Asian markets on, for example, cattle over 30 months or some offals. There's just great opportunity. You look at Vietnam, and our tariff rate dropped down to 0, and just markets that we haven't perhaps had an opportunity in previously. But when you look at Asia as a whole, there's just such great opportunity there.
Well, thanks for your responses, Dennis, Michael, and Fawn. It looks like we don't have any additional questions this evening. So I'd like to thank everyone who did submit questions tonight for participating. And before we close tonight's meeting, I'd like to open the floor to Bob and Michelle again for closing comments. Bob?
You took me by surprise, Michelle. Sorry. I guess first thing I'd like to say is thank you to the speakers tonight, and a special thanks to Farm Credit Canada for arranging for Craig to join us and give us some pretty valuable insights into what's happened and what's going to happen in the future. As 2020 comes to a close, we look forward to continuing to work on behalf of Canadian beef producers. We appreciate the close working relationship and collaboration we've had with our provincial member associations and national partners to bring meaningful solutions and outcomes for the benefit of the industry. 2020 has not been an easy year, and I would encourage us all not to become complacent just yet. We seem to be on the tipping point of COVID, so let's do our part to beat it. Let's think ahead to the spring bull sales and be prepared to do what we need to do to make them successful and keep everyone healthy. I believe 2021 will be a time of rebuilding, and the Canadian cattle industry can be a major player in this effort, but we do need some help. I'd like to ask producers to talk to their MLAs to get the provinces on board with the feds and accept the changes to agri-stability. Nothing will change unless the provinces align with the federal government on the proposed changes. So that's something that we all need to do, and we need to do it sooner rather than later if we want it to be retroactive in 2020. And with that, I'd just like to wish everybody on the call and their families a safe and healthy holiday season and Merry Christmas. Thank you. Michelle?
Thank you, Bob. I will be really short. I hope 2021 will bring us more money in our pocket. We cannot lose more money than this year. Every one of us hope that the future is better for everyone. So stay healthy, be patient, and pay attention to every one of you. And if you're like it was in Quebec in the first wave of COVID-19, I think you out in prairies are in huge trouble like us. So pay attention to your health and safety and to your collaborators at the farm. So I was really happy to the lot of information we received tonight from Brian and CCA and FCC, and I'm really happy to have the opportunity to talk to you tonight. So good evening, good night.
Thank you everyone for joining tonight's town hall. There will be a short survey when you exit tonight's meeting. We would ask that you complete the survey to provide us with important feedback for future virtual town hall meetings. If you have any follow-up questions, please feel free to email me at mcmullinm@cattle.ca. Thank you and stay healthy. Merci et prenez soin de vous. Happy holidays and joyeux fête. Good night.